In this video, we're going to talk about 7 mistakes 401k investors make and how to avoid them. Before starting, please do like the video and subscribe to this channel for future updates. It is essential for investors to do everything in their power to ensure that the performance of their 401k accounts is optimized regardless of how far off their retirement may be. If participants in 401k plans want the opportunity for a higher income during retirement, they should steer clear of the following 7 common blunders. Number 7, not taking advantage of your company match. Investors who do not take advantage of the employer match are making another 401k mistake that they should try to avoid. One of the most effective and most sometimes disregarded strategies for getting the most out of your 401k is to take advantage of employer contributions. If you are unable to contribute the maximum amount each year, you should at least contribute enough to receive the full match from your employer. Because getting matched by your employer is almost the same as getting money for free, if you aren't already doing it, you may be leaving a lot of money on the table if you don't start now, because it has the potential to improve the way you live in retirement. In addition, it could facilitate the accumulation of the sum of money that you require for retirement. Keep in mind that you do not need to wait until enrollment season in order to make adjustments to the deferral election you have selected for your 401k. You are free to make adjustments at any point throughout the year. It is never too late to take charge of your financial destiny. It does not matter how old you are or how much money you have saved up to this point. Number 6, not maximizing 401k contribution limits each year. Contributing the maximum amount allowed during any given year is one strategy to potentially increase the likelihood that you will have sufficient funds to support yourself throughout retirement. According to How America Saves, published by Vanguard in 2017, only 13% of employees who had access to workplace retirement plans saved the maximum allowable amount for their 401k, which was $18,000 at the time, and only 14% of individuals who were 50 or older took advantage of programs that allowed them to make catch-up contributions. The maximum amount that an employee under the age of 50 can contribute to their 401k, 403b, most 457 plans, and the thrift savings plan each year has increased to $19,000. This increase applies to employees who participate in the federal government's thrift savings plan. This is a $500 increase compared to 2018. The additional catch-up contribution ceiling of $6,000 per year will continue to apply to workers who have reached the age of 50 or older in 2019. The amount of money that you are really able to put into your 401k plan is dependent, among other things, not only on how much money you earn, but also on how much debt you carry. Do what you can, even if it's a stretch, to get as close to the 401k contribution limitations as feasible with the money that you save. Number 5, relying solely on target date funds. Target date funds, also known as funds with retirement ages of 2020, 2030, 2040, and 2050, fail to take into account the fact that not all investors are created equal because they are predicated on the date of retirement. It is recommended that you choose a 2060 fund if you are younger and want to retire in 2060 or later. You should choose a target date fund for the year 2030 if you're planning to retire in that year. This indicates that the only factor that is used to categorize investors is their anticipated retirement age. Factors such as location, career, pay, level of risk, tolerance, goals, and objectives are not taken into account. Investing in a 401k plan is not something that can be simplified into a single all-encompassing strategy because people's hopes and dreams for the future vary greatly. In addition, target date funds do not adequately manage the risk of a decline in market value. It is possible that they underperform the market on a regular basis and do a poor job of mitigating downside risk when the market is volatile. Number 4, failing to rebalance your 401k quarterly. If you don't rebalance your account allocations on a regular basis, you might be passing up opportunities to earn more and keep more of the money you've earned so hard to save for retirement. Why? Because unmanaged allocations run the risk of incurring significantly higher losses when markets are falling and may cause investors to miss out on growth opportunities when markets are performing well. A study was carried out by Morningstar which tracked the top 100 mutual funds in terms of their performance over the period of time between January 1, 1998 and December 31, 2013. According to the findings of this study, most of the top 100 mutual funds in terms of performance in any given year, only roughly half of those funds, or 8 out of every 100, continued to be ranked in the top 100 the following year. This occurred for each given year. Because of this, a strategy of setting it and forgetting it is not always the best option. Despite this, a small percentage of people actually rebalance their 401k account, and even those who do so often fail to properly manage risk by allocating their assets. In point of fact, more than 80% of 401k owners do not rebalance their portfolios. Simply rebalancing to your initial goal percentages is not sufficient because it does not take into consideration the situation of the market or the economy at the present time. When market conditions are poor, this frequently leads in greater financial losses. You should not assume that the stock or mutual fund that you picked out a year or even a quarter ago is still heading in the direction that is best for you. It is possible, but not guaranteed, that this is not the case. Number 3, not making changes to your 401k. When it comes to 401ks and other types of workplace retirement funds, traditional investors have historically been advised to adopt a set-it-and-forget-it investment strategy. Although investing for retirement is a game played over a lengthy period of time, the buy-and-hold investment strategy is the number one mistake that 401k investors make, and one that could end up being quite expensive while also posing the risk of doing more harm than good. It's possible that the investments you selected in the past to assist you in meeting your retirement objectives are not the most effective choices for you now. This is true whether it was 20 years ago or just 2 years ago. Why then would you put the money you've worked so hard to save into a 401k or another type of retirement account at your place of employment and then just forget about it? It is essential to take the necessary adjustments in order to maintain your current trajectory and get the most out of your retirement resources. Which brings us to the second mistake that those who invest in 401k plans should try to avoid. Number 2, thinking your employer is taking care of your 401k for you. Investors should also steer clear of making the assumption that their company, whether present or previous, will take care of their 401k accounts. This is another common 401k mistake. This misconception causes investors like you to become emotionally detached from their wealth, which may prevent you from making the most of your retirement resources. Your employer is unable to make any modifications on your behalf. It is up to you to take control of your financial destiny and make certain that you are aware of everything that is happening with your investments in your 401k plan. Number 1, not regularly reading your 401k statements. Many workers have such a lackadaisical attitude toward their retirement savings that they don't even bother to read their 401k statements. Too many people cling to the hope that they will have enough money saved for retirement rather than actively managing their 401k plans. Even while going over the statement for your 401k plan might not be the most riveting thing you've ever read, it's critical that you have a solid grasp on the information that's being presented to you in order to make the most of your retirement savings. You can assess whether or not you are on track to reach your financial goals by opening and reading your statements. This helps you keep track of your progress. Do you look over your monthly bill each time it arrives? Do you have any idea why you experience the things that you do? If you answered no to both of these questions, one of the best things you can do for your retirement funds is to get involved with them. Open your statements. If you are unable to comprehend the information that you're receiving, you should seek the assistance of a specialist. So, what did you think about our video? Let us know in the comment box below, and please do like this video and subscribe to our channel for future updates.